Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our June monthly market update. Before we begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So first of all, we have a team member announcement. Nick Dominguez joined us just over 1 year ago. So he's celebrating his 1 year anniversary serving our amazing clients. We also hope to see many of you next month at our quarterly investment forum on Wednesday, July 24th. And we also hope many of you will participate. We've still got another announcement that will go out, an AI webinar on June 26th at 11 o'clock Central Time. So as it relates to markets that are at about 54 to 5,500 remain near all-time highs in the S&P 500. One of the questions being asked about today's market is the market top heavy, which means that at the very top of the S&P 500, roughly 37% of the capitalization are made up by only 10 names. Many of those are mega cap tech names. So one of the interesting things about this, the answer to this question is, what percentage of net income does that 37% occupy? The real answer to that is 31%. So that the answer to this question is, yes, it's heavy, but as it relates to percentage of net income, not as much. Another measure that just isolates the Mag 7 was that net income growth for the Mag 7 was 52% for the first quarter of this year, negative 9% for the remaining 493. So the answer to the question is, yes, the market is top heavy, but not disproportionate to net income or income growth. As it relates to the economy continues to grow, although the reading of Q1 GDP was only at 1%. We know this is a consumer-led economy, so the faring of the consumer, which drives 70% of this number, is relevant, and the consumer is showing some signs of weakness, particularly in debt service, which measures how much household income does it take to just service debt. That number has gone up to now 10%. And delinquency rates on things like credit card and auto loans are starting to pick up. So the consumer is showing some signs of weakness, in addition to the savings rate that had accumulated during COVID. That savings rate is burning off at a pretty fast pace. The jobs report in May was overall pretty good. You had 272,000 jobs created. Unemployment rate, because participation rate picked up a bit, went up to 4. Average hourly pay over the last 12 months at 4.1. CPI, the most recent print, was overall positive. Because it was a little bit less hot than anticipated. So 3.3 was the annual read on the most recent month, which caused the Fed to kind of make some accommodating comments. Now, what that means in terms of rate cuts the rest of the year, we have 4 different decision-making points. Most believe we'll have 1 or maybe none at all in terms of rate cuts the rest of the year. But these are the meetings, and you'll notice one of them is immediately post-election. So if you take that off the table, you're looking at 3 opportunities. I think July is likely too soon. September and December, I think, would be the most likely times for the Fed to cut if they do this year. The average length of time from the first rate hike to the first, or for the last rate hike to the first cut, is 10.5 months. We're now basically past that period of time because the last raise was in the summer of 23, and here we are in the summer of 24. So it looks to be a longer than average last hike to first cut. Another concerning item, and this is connected to interest rates as well, is where we are as it relates to spending. Right now, debt level is 120% of GDP. And you see we have to go back to World War II before we're near that level. And this is the CBO projections. So this debt level is not an issue that day to day we talk about probably enough, but it's something to be following. In fact, the U.S. debt payments were $1 trillion for the first time ever going forward. So just the servicing of the debt is now at $1 trillion. So all that said, what are kind of some reasons for optimism that we continue to get a delay in the recession, meaning we don't get one, that the Fed does cut interest rates. Again, that's likely to happen maybe once at the back half of the year, that this performance and concentration at the top of the market widens out to a broader group of stocks. Earnings, which did in large measure beat in Q1, continues to be good. In an election year, I'm going to mention this in both optimism and pessimism because there's reasons to be both. A reason for pessimism is we do get the long anticipated recession, likely led by a consumer that's weakening. The Fed cuts rates, but less than expected, or maybe not even at all in 2024. Geopolitical risk we know is elevated today. Earnings start to weaken in Q3 and beyond. An election year means that there's just a lot of uncertainty post-election. That said, in an election year, if we look at quarter over quarter, what the averages are, kind of a muted first and second quarter, but this on average is the third and fourth quarter of a presidential election year going back almost 100 years. And if we look at election years compared to the markets overall, if we go back to the same 1926 timeframe, basically 7 out of every 10 years in the market overall is up. But if we apply that to election years, it's more like 8 out of every 10 years. So election years overall tend to be up. So that's a brief look of how we're seeing markets and things to look for in the back half of this year. Again, we hope to see many of you at our upcoming quarterly investment forum. None of this information that we shared is a substitute for talking to us about how all of these things affect you directly. So please contact us if you have any questions at all. So with that in mind, we'll close. Again, we want to thank you for the trust and confidence that you place in us. We hope to see many of you next month at our quarterly investment forum. Until we see you again, be well and take care.